All right, let's get right into it. If you're doing business in Egypt, something new is about to show up on your company's books, and it's all about carbon. We're going to break down the brand new accounting standard for what are called carbon emission reduction certificates. So you probably remember all the buzz around the COP27 climate summit in Sharm el-Sheikh, right? Well, one of the big ideas from that conference has now trickled all the way down from global policy right onto your company's balance sheet. A whole new type of asset has been created, and if you're an accountant or a CFO, you need to get up to speed on this, and fast. So where did this come from? It all really started with Egypt's first voluntary carbon market, which was announced back in 2022. The whole idea was to build a proper, regulated system for trading carbon reductions. But to do that, you need a standard unit, something everyone can trade. And that unit is the Carbon Emission Reduction Certificate. Here's the most important thing you need to know. One certificate equals exactly 1 ton of CO2 equivalent that's been stopped from going into the atmosphere. It's not just an idea. It's a real, verifiable, and tradable instrument officially recognized by the Egyptian Stock Exchange. But where did these things actually come from? And where do they end up? To really get how to account for them, we first have to understand their journey, their entire life cycle. You see, there's a whole ecosystem of players here. You've got the project developers. These are the folks running things like solar farms that cut down on emissions. Then you have verification bodies who act like independent auditors, making sure the carbon reductions are legit. Registries are the official scorekeepers that issue and track every single certificate. Of course, you have traders who buy and sell them. And finally, you have the end users, the companies that buy these certificates to balance out their own carbon footprint. And this breaks that journey down perfectly. First, a certificate is created. It's born, really, right after a project's emission cuts are verified. Then it can be traded on the market, passed from the developer to maybe a trader or straight to a company that needs it. And finally, and this part is absolutely crucial, an end user retires it. That means it is permanently taken out of the system. It can't be used again. That's when the company can officially say, we offset 1 ton of carbon. Okay, so now we get to the real head scratcher for all the finance pros out there. You've got this new asset, but what is it? How in the world do you classify it on your books? This has been a huge puzzle, and it's exactly what this new government decree finally clarifies. The whole accounting treatment, literally all of it, comes down to this one question. Is this certificate an intangible asset, kind of like a patent or a brand name, or is it a financial instrument, more like a stock or a bond? Well, the answer depends completely on why you're holding it. This slide nails it. A single certificate can have 2 different identities, and it's all about your intent. If your company is holding a certificate because you plan to use it to offset your own emissions and hit your sustainability targets, then you treat it as an intangible asset. That falls under Egyptian Accounting Standard 23. But if you're holding that very same certificate just to sell it and make a profit, well, then it's a financial instrument and you follow Standard 47. Your intention is everything. Okay, so let's walk through how this actually plays out in the real world. The new regulation lays out 4 main scenarios that pretty much cover any situation you'll run into. Think of this table as your ultimate cheat sheet. It all boils down to 2 simple questions. Who are you, and what are you planning to do with it? As you can see, your role, are you the one making the certificate or the one buying it? And your purpose, are you offsetting or trading? That's what decides the accounting treatment. Let's just quickly go through each one. First up, the developer owner. So let's say you own the solar farm that generates these certificates. You've got a choice here. You can use them to make your own company carbon neutral, which makes them an intangible asset that boosts your brand's green image. Or you could sell them on the open market, which makes them a financial instrument and opens up a totally new way for you to make money. Next, maybe you're a developer who helps manage or finance a project for someone else, and you get a cut of the certificates as your payment. In this case, there's no question about your intent. You're in it to sell your share for a profit. So for you, these are always classified as financial instruments, plain and simple. Now, this is going to be a really common one. Your company goes out and buys certificates on the market for one reason and one reason only, to retire them and offset your own emissions. Because the purpose is purely for internal use, they're always booked as intangible assets. You can think of it as an investment in your company's reputation and its future, something your stakeholders are definitely paying attention to. And last but not least, we've got the pure trader. If your company buys certificates not to use them, but just to hold on to them and hopefully resell them later for a higher price, you're basically treating them like any other commodity. So they are always accounted for as financial instruments sitting in your trading inventory. Just remember, this means you're exposed to market swings, big potential upside, but also the risk that prices could go down. So we know the rules of the game now. What does this actually mean for your company's next financial report? Well, there are some very specific new things you've got to start including. Right. You can't just put the asset on your books and call it a day. Your company's financial statements now have to have detailed disclosures. You have to clearly state which accounting policy you chose, explain how you value the certificates, and provide a full breakdown of your holdings from the beginning of the year to the end, including any you added or retired. It's all about transparency. And here it is. This might be the most important slide in this whole thing. This isn't some far-off concept. This is happening right now. The mandatory date to implement this new standard is January 1st, 2025. You can start early if you want, but by the top of 2025, everybody has to be on board. The clock is officially ticking. So when you step back and look at the big picture, this new standard does so much more than just clear up some accounting rules. It officially turns carbon reduction into a real asset on the balance sheet. And that leaves us with a really interesting question to think about. As carbon becomes a formal financial asset, will we see companies finally shift their mindset and start treating sustainability less like a cost and more like a core strategic financial opportunity? That could change everything.